What if the biggest threat to the US economy isn't inflation? What if it isn't the national debt? And what if it isn't even the stock market? What if the real threat is something much bigger? A shift in the global financial system that has quietly been supporting America's economic power for more than 50 years? Right now, a series of events are unfolding that could reshape the future of money, oil, global trade, and investing. One of America's closest allies is challenging a system that has existed for decades. Oil-producing nations are exploring alternatives to the US dollar. China is expanding its influence across global trade routes. Central banks around the world are buying gold at record levels. And investors are asking a question that would have sounded impossible just a few years ago. Could the world's financial system be entering a completely new chapter? Today, we're breaking down one of the most important economic stories happening right now. We'll explain why major oil-producing countries are changing their strategy, how the Petro-Dollar system helped make the US dollar the world's reserve currency, why China, gold, and global trade are becoming increasingly important, and what all of this could mean for your investments, your savings, and the future of the global economy. Because whether you're investing in stocks, real estate, Bitcoin, gold, or retirement accounts, this story matters. Let's dive in. At first glance, this appears to be a story about energy. Oil prices are rising. Supply chains are under pressure. Global markets are reacting. But beneath the surface, something much more important is happening. This is a story about power, economic power, financial power, and the power that comes from controlling the world's most important currency. For decades, the United States has enjoyed a unique advantage. The US dollar isn't just America's currency. It's the world's currency. Countries use dollars to trade. Central banks hold dollars as reserves. Governments buy US Treasury bonds. Businesses settle international transactions in dollars. And perhaps most importantly, oil has traditionally been priced and traded in dollars. This created a powerful cycle. Countries needed oil. To buy oil, they needed dollars. To get dollars, they bought American assets. This constant demand helped strengthen the dollar and supported US financial markets. But what happens if that system starts to change? That's the question investors are beginning to ask. And to understand why, we need to go back more than 50 years. The year was 1971. At the time, the global financial system worked very differently. The US dollar was tied to gold. Foreign governments could exchange dollars for gold at a fixed rate. This arrangement gave countries confidence in the dollar. After all, every dollar represented something tangible. But as government spending increased and more dollars entered circulation, maintaining that system became difficult. Then came a historic moment. President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. The world was shocked. For the first time in modern history, the global reserve currency would no longer be directly linked to a physical asset. Instead, it would rely largely on trust. And trust is powerful, but trust alone isn't always enough. The challenge became obvious. Why would countries continue holding large amounts of dollars if those dollars were no longer backed by gold? The answer emerged a few years later, and it would transform global finance forever. In the 1970s, oil was already the lifeblood of the global economy. Every nation needed energy. Factories needed it. Transportation depended on it. Economic growth required it. Recognizing this reality, US policymakers helped establish a framework that would shape international trade for decades. Oil-producing nations agreed to sell oil primarily in US dollars. In return, those nations gained access to financial markets, investment opportunities, and security partnerships. This arrangement became known as the Petro-Dollar system. The effects were enormous. Imagine you're a country that wants to buy oil. First, you need dollars. To obtain those dollars, you must participate in a dollar-based financial system. That creates demand, and demand creates strength. The result? The US dollar became deeply embedded in global trade. This helped America borrow at lower costs. It strengthened US financial markets, and it reinforced the dollar's position as the world's reserve currency. For decades, the system worked remarkably well, but every system eventually faces challenges. And today, those challenges are becoming increasingly visible. The global economy in 2026 looks very different from the one that existed 50 years ago. Back then, the United States dominated global manufacturing. Its economy was unrivaled. Its financial markets were unmatched. its influence was nearly unquestioned. Today, the world is far more competitive. China has become an economic powerhouse. Emerging markets have grown rapidly. Technology has transformed international commerce, and countries now have more options than ever before. As a result, some governments are asking important questions. Should all international trade rely on one currency? Should reserves be diversified? Should critical resources be priced differently? These questions don't necessarily mean the dollar is disappearing. Far from it. The dollar remains the dominant global currency. But dominance and monopoly are not the same thing. And that's where today's story becomes fascinating. Around the world, countries are gradually exploring alternatives. Not because they want to abandon the dollar overnight, but because diversification can reduce dependence on any single system. This trend is visible in multiple areas. Trade agreements, currency arrangements, gold purchases, cross-border payment networks, and strategic partnerships. Together, these developments suggest a world becoming increasingly multipolar. No discussion of global economic change would be complete without talking about China. For decades, China's strategy has focused on long-term economic expansion. While many countries concentrated on financial growth, China invested heavily in physical infrastructure, ports, railways, manufacturing, energy projects, supply chains, mining operations, and critical industrial materials. These investments weren't random. They were strategic. China understood that controlling supply chains could create long-term economic influence. Today, China plays a major role in global manufacturing. It processes significant portions of key industrial materials. It remains deeply integrated into international trade, and it continues developing alternatives to traditional financial networks. This doesn't mean China is replacing the United States, but it does mean the global economy is becoming more competitive. And competition changes behavior. Countries begin exploring options. Businesses seek flexibility. Investors diversify risk. That's exactly what we're seeing today. One of the most interesting developments in recent years has been the resurgence of gold. For decades, many investors viewed gold as an outdated asset, something associated with previous generations, something less exciting than stocks or technology. But central banks appear to see things differently. In recent years, many central banks have significantly increased their gold purchases. Why? Because gold possesses characteristics that few other assets can match. It isn't issued by a government. It can't be printed. It has thousands of years of monetary history, and it often performs differently from traditional financial assets. For central banks, gold can serve as a form of diversification, a reserve asset that exists outside traditional financial systems. That's one reason gold has attracted renewed attention, not because the financial system is collapsing, but because governments are preparing for multiple possibilities. And preparation is often what separates strong institutions from vulnerable ones. The same principle applies to investors. The future remains uncertain. No one knows exactly how these trends will unfold, but understanding them can provide valuable perspective. Because history teaches an important lesson. Major economic transitions rarely happen overnight. They occur gradually, then suddenly. And the investors who recognize the trend early are often the ones best positioned to adapt. Now that we understand the history behind the petrodollar system and why global financial power is shifting, let's focus on one of the most important pieces of this story: oil. Because whether people realize it or not, oil remains one of the most important commodities in the world. Every day, millions of barrels of oil power transportation systems, manufacturing facilities, agriculture, shipping networks, and entire economies. Almost everything you use has been touched by oil in some way. The food you eat, the products you buy online, the fuel used to transport goods around the world, the electricity that powers certain industries. Oil is everywhere. That's why even small disruptions can create major consequences. Historically, whenever energy prices rise rapidly, economic pressure tends to follow. Businesses face higher operating costs. Consumers spend more on fuel. Transportation becomes more expensive. Supply chains become less efficient. And inflation often begins to accelerate. This is why investors watch oil markets so closely. Because oil isn't just another commodity. It's often considered a leading indicator for economic conditions. When oil prices remain stable, economies tend to function more smoothly. But when prices become volatile, uncertainty increases. And uncertainty is something financial markets dislike. Today, many investors are asking, could the next phase of economic volatility begin in energy markets? Nobody knows for certain, but history suggests that major energy disruptions often create ripple effects far beyond the oil industry itself. And that's exactly why global markets are paying attention. One of the biggest stories in global finance right now involves the Gulf region. Countries such as Saudi Arabia, the United Arab Emirates, Qatar, and Kuwait have played a critical role in global energy markets for decades. These nations control enormous energy resources. They influence production levels, and they hold significant financial assets across the world. Together, sovereign wealth funds in the Gulf region manage trillions of dollars. These investments include American stocks, real estate, infrastructure, treasury securities, technology companies, private equity investments, and global financial assets. Because of this, the decisions made by Gulf nations often have worldwide consequences. When these countries invest, markets notice. When they diversify, markets notice. And when they begin exploring new partnerships, markets definitely notice. Over the last several years, Gulf nations have increasingly expanded relationships with major economies outside the traditional Western financial system. This includes stronger economic ties with Asia, expanded trade agreements, infrastructure investments, technology partnerships, and broader international cooperation. The key point isn't that they're abandoning existing relationships. It's that they're creating more options, and options create leverage. For investors, this highlights an important reality. The world is becoming more interconnected, but it's also becoming more competitive. Countries are no longer relying on a single economic partner. They're building relationships in multiple directions. And that trend could reshape global trade for decades to come. For many years, international finance operated through a relatively small number of systems. Money moved through familiar networks. Cross-border payments followed established routes. And most global transactions ultimately flowed through dollar-based channels. Today, that landscape is changing. Several countries are developing alternative payment systems, new settlement mechanisms, regional trade arrangements, and digital financial infrastructure. Why? Because every nation wants greater flexibility. Imagine running a business that depends entirely on a single supplier. Wouldn't you eventually want a backup option? Countries think the same way. Diversification reduces risk. That's why we're seeing increased experimentation with local currency trade agreements, cross-border digital payment platforms, central bank digital currency research, and alternative settlement systems. These developments don't mean the dollar is disappearing. The dollar remains the dominant currency in global finance. But they do suggest that the future may involve a more diversified monetary ecosystem, one where multiple currencies play larger roles in global commerce. For investors, understanding these changes is important because financial systems evolve slowly. Then suddenly, the biggest shifts often begin years before they become obvious. And by the time everyone notices, the trend is already well underway. While most people focus on stocks, experienced investors often watch a different market, the bond market. Why? Because bonds influence nearly everything. Mortgage rates, corporate borrowing, government financing, business investment, consumer credit, and economic growth. When governments borrow money, they issue bonds. Investors buy those bonds in exchange for interest payments. Simple. But here's where things become interesting. The larger a government's debt becomes, the more important investor confidence becomes. Investors want assurance that they'll be repaid. If confidence remains strong, borrowing costs stay manageable. But if confidence weakens, investors often demand higher yields. Higher yields mean higher borrowing costs. And higher borrowing costs can slow economic activity. This relationship is one reason economists closely monitor government debt levels. Not because debt automatically causes problems, but because borrowing becomes more expensive when confidence declines. For the United States, this matters enormously. America operates the largest and most important bond market in the world. Treasury securities are widely considered among the safest financial assets available. But even safe assets require confidence, and confidence must be maintained. That's why bond markets often serve as an early warning system for broader economic concerns. When investors become nervous, bonds frequently react before stocks do. And right now, many analysts are paying very close attention. Another major theme shaping the future is government debt. Not just in America, across much of the developed world. Over time, governments have accumulated significant debt burdens. Some debt can be beneficial. It funds infrastructure, supports economic growth, and provides flexibility during emergencies. The challenge arises when debt grows faster than the economy itself, because eventually, interest costs begin consuming larger portions of government budgets. Think of it this way. Imagine earning $5,000 per month. If your debt payments are $200 monthly, that's manageable. But if those payments grow to $2,000 monthly, your financial flexibility shrinks dramatically. The same concept applies to governments. As debt increases, interest expenses increase. And when interest expenses rise, fewer resources remain available for other priorities. This doesn't mean disaster is imminent. Far from it. But it does mean policymakers face increasingly difficult choices. Raise taxes? Reduce spending? Borrow more? Encourage economic growth? Each option carries trade-offs. And those trade-offs will likely shape economic policy throughout the coming decade. Now let's talk about what investors really want to know. How does all of this affect stocks? The answer is complicated. Because markets are forward-looking. Stock prices don't simply reflect today's economy. They reflect expectations about tomorrow. When investors feel optimistic, markets often rise. When uncertainty increases, volatility usually follows. Right now, markets are balancing several powerful forces. On one side, artificial intelligence, innovation, productivity gains, corporate earnings growth, technological breakthroughs. On the other side, debt concerns, energy risks, inflation pressures, geopolitical uncertainty, and changing global trade dynamics. Which side wins? Nobody knows. And anyone claiming certainty is probably oversimplifying a very complex situation. The reality is that markets have historically overcome enormous challenges. Wars, recessions, financial crises, inflation, political uncertainty, and technological disruption. Yet over long periods, productive businesses continue creating value. That's why long-term investing remains so powerful. Because despite short-term volatility, innovation tends to move forward, and economies tend to adapt. Whenever uncertainty rises, investors begin looking for alternatives. Historically, gold has been one of those alternatives. For thousands of years, gold has served as a store of value. It's scarce, recognized globally, and independent of any single government. More recently, Bitcoin has entered the conversation. Supporters argue that Bitcoin offers similar scarcity characteristics. Critics argue that it's still too volatile. Regardless of where you stand, both assets represent something important: a desire for diversification. Investors are increasingly looking beyond traditional financial assets. They're asking new questions. How should portfolios be structured? What happens if inflation returns? What happens if currencies weaken? What happens if global systems continue evolving? There are no easy answers. But these questions explain why alternative assets continue attracting attention, and why discussions about gold and Bitcoin are becoming increasingly mainstream. If there's one lesson history teaches repeatedly, it's this: the world changes. Financial systems change. Economic leadership changes. Technology changes. Markets change. But successful investors adapt. They don't panic. They don't chase headlines. And they don't make emotional decisions based on fear. Instead, they focus on fundamentals. They diversify. They manage risk. They remain informed. And they think long-term. Because the goal isn't predicting every economic event. The goal is building a strategy capable of surviving uncertainty. That's what separates successful investors from everyone else. Not perfect predictions, but disciplined preparation. So where does all of this leave us? The global financial system appears to be entering a period of transition. Oil markets are evolving. Trade relationships are shifting. Central banks are accumulating gold. Alternative payment systems are emerging. Government debt remains a major challenge. And technological innovation continues transforming the economy. Does this mean the end of the dollar? No. The dollar remains the world's dominant reserve currency. Its financial markets remain unmatched. Its influence remains enormous. But dominance doesn't mean permanence. Every financial system evolves over time. And the trends we're seeing today suggest that the next chapter of global finance may look different from the last 50 years. For investors, that doesn't mean panic. It means awareness. Because awareness creates preparation. Preparation creates resilience. And resilience creates opportunity. The future will belong to those who understand change rather than fear it. Because while headlines focus on crises, the smartest investors focus on adaptation. And that may be the most valuable investment lesson of all. If you enjoyed this deep dive into the future of the global economy, make sure to hit the like button, subscribe to the channel, and turn on notifications for more finance, investing, wealth building, and economic analysis videos. And now I want to hear from you. Do you think the US dollar will remain the world's dominant reserve currency over the next 20 years? Or are we witnessing the beginning of a new financial era? Comment below, and I'll see you in the next video.